Hey there and welcome to our channel. Today we will be discussing uncovering the $80 trillion threat, the hidden debt in currency swaps and its potential impact on the global financial system. We're excited to share our thoughts and insights with you, so let's get started. The Bank of International Settlements, BIS, has recently released a report highlighting a ticking time bomb in the form of derivatives, which are financial instruments with the potential to cause significant harm. The report states that the total amount of these types of derivatives, including foreign exchange swaps, FX swaps, is around $100 trillion, with 80% of the $85 trillion in dollar-denominated derivatives due in 2023. This creates forward dollar payment obligations, which are missing from standard debt statistics. The hidden $80 trillion debt in currency swaps has the potential to wreak havoc on the global financial system if companies default on their obligations. According to the Bank for International Settlements, BIS, this off-balance sheet debt poses a particular challenge for regulators and policymakers as it is not captured in standard debt statistics. The debt has grown from just over $55 trillion a decade ago and now exceeds holdings of dollar treasury bills, repurchase agreements, and commercial paper combined. For non-U.S. banks and other financial institutions such as pension funds, dollar obligations from currency swaps are now twice as high as their on-balance sheet dollar debt. The BIS warns that currency swap markets are vulnerable to funding shortages, as was evident during the 2008-09 financial crisis and again in March 2020 when the COVID-19 pandemic hit the world. Despite the differences between 2008 and 2020, currency swaps proved to be flashpoints in both instances, as dollar borrowers had to pay high interest rates to borrow at all. If companies default on their currency swap obligations due to the high interest rates, the consequences for the global financial system would be dire. The hidden debt would suddenly become visible, exposing the true extent of the problem and potentially triggering a financial crisis. A large number of companies and financial institutions could be pushed into insolvency, which would lead to a sharp decline in confidence in the financial system and a decline in asset values. Moreover, a default in the currency swaps market could result in a domino effect, leading to a credit freeze and a global recession. The banks and other financial institutions that are most exposed to this debt could face severe losses, putting pressure on their balance sheets and putting the stability of the entire financial system at risk. The BIS says that while the Fed may have policy tools to combat this, they can only be directed at specific countries, and it's unclear how the Fed would even know where all these companies with financial WMDs are hiding, creating a huge risk for black swan events in the next 12 months. What are FX swaps? FX swaps are a type of derivative discussed in the report. They refer to an agreement to simultaneously borrow one currency and lend another currency, exchanging the amounts at maturity. The transaction has two legs, the first leg being at the prevailing spot rate and the second leg at the predetermined forward rate. FX swaps are useful for borrowing and lending amounts without taking out a cross-border loan, eliminating foreign exchange risk by locking in the forward rate. A practical example would be two parties, Party A who is Canadian and needs EUR, and Party B who is European and needs CAD. They enter into a foreign exchange swap for 6 months, agreeing to swap €1 million or 1,500,000 CAD at a spot rate of €1.50 per CAD and a forward rate of €1.60 per CAD due to expectations of CAD depreciation relative to EUR. In 6 months, they return the currencies they borrowed and receive the currencies they lent. In conclusion, the hidden $80 trillion debt in currency swaps is a ticking time bomb that has the potential to destroy the global financial system if companies default on their obligations. Regulators and policymakers must take proactive measures to address this issue, including better monitoring and reporting of off-balance sheet debt and improving the resilience of the currency swaps market. The world cannot afford another financial crisis, and the time to act is now. Thanks for watching our video. We hope you enjoyed it and learned something new. If you liked it, please give it a thumbs up and consider subscribing to our channel for more content like this. Don't forget to leave a comment and let us know what you thought. Until next time, take care.